Let me begin by introducing the concept of working capital management. Working capital management is the process of efficiently managing a company's short-term asset and liability, such as cash, inventory, account receivable, and account payable. Its main goal is to maintain enough liquidity for daily operation while minimizing dependence on external borrowing. Why is this important? First, it ensures that a company has enough cash to pay suppliers, employees, and other short-term commitments. Second, it improves operational efficiency by reducing delay in inventory turnover and cash collection with both profitability. Third, effective working capital support a company's financial stability and growth by enabling timely payment and reinvestment opportunities. And lastly, it helps avoid bankruptcy as poor cash flow management can lead to missed payment and potential business failure. A key part of this process is managing the cash conversion cycle, the time it takes to turn inventory investment into cash from sale. The shorter the cycle, the better the cash flow. To illustrate this action, we will look at Mr. DIY Group and Berhad, Malaysia's largest home improvement retailer. Founded in 2005, Mr. DIY now operates over 1,200 stores nationwide and offer more than 70,000 everyday items at affordable price. With a strong focus on customer value, innovation, and sustainable, Mr. DIY is not only a local success story but also expanding across Asia, including in Thailand, Brunei, and the Philippines. Through this presentation, we will explore how Mr. DIY effectively manage its working capital to support its growth and long-term success.
Inventory are a key part of Mr. DIY working capital. With more than 17,000 stock keeping units, effective inventory management is crucial for daily operation. In fiscal year 2023, Mr. DIY focused on increasing inventory turnover and avoiding stock shortage. Moving on to account receivable, Mr. DIY operates primarily on a cash and carry model. This means most transactions are paid upfront at the point of sale, significantly reducing the amount of receivable and minimizing the risk of bad debt. Although some receivables may still arrive from corporate partnership, bulk orders, or online sales, they are not significant. This setup allows companies to have healthy cash flow and quickly reinvest cash into expansion or operation.
Let's look at account payable. These represent the company's short-term obligation to suppliers and service providers. In financial year 2023, Mr. DIY recorded procurements costs totaling approximately 2.38 million ringgit, reflecting the scale and efficiency of its purchasing operations. By leveraging strong supplier relationships and data-driven inventory management, the company is able to strategically delay payments. This approach improves cash flow and reduce the need for external short-term financing without compromising supplier trust. Next, we move on to cash. Cash management is essential for ensuring liquidity and meeting day-to-day operational needs. In financial year 2023, Mr. DIY maintained solid cash reserve while continuing to expand. The company invested over 100 million ringgit in infrastructure, including automation and the opening of 175 new outlets. Despite this significant investment, Mr. DIY also distributes 302.1 million ringgit in dividends. This indicates strong internal cash generation, supporting both financial stability and future growth.
Okay, now I'll be sharing how Mr. DIY managed its cash efficiently in 2023, despite rapid expansion. Firstly, the company maintained a strong liquidity through robust operational cash flow from its growing retail business. With over 165 million customer transactions, their day-to-day sales provided a steady source of cash. And then they also shown prudent capital spending, investing 106.5 million in new stores, each costing around 552,000. These stores were chosen in high growth area, with investment typically recover within 2 years. In addition, they invested 1 million into a fully automated warehouse. This facility is expected to save 10,000 million annually in rental and labor costs, a move that directly supports a long-term cash flow. Mr. DIY also practiced smart inventory management. They stock fast-moving, high-margin house brand product which made up 49% of their sales and helped them keep cash tight to profitable items. The use of data analytics enabled them to fine-tune product mix and avoid overstocking slow-moving items, which keep cash circulation efficiently. Lastly, the company's confidence in its cash position is reflected in their dividend payout of 302.1 million. Stay true to their policy of distributing 50 to 65% of net profit to shareholders. Overall, Mr. DIY disciplined cash management approach ensure that stay financially strong while growing aggressively.
Next, we will go through working capital financings by Mr. DIY. There are 5 ways that Mr. DIY use to finance their working capital. So, for the first one is they use a very strong internal cash flow by having a very profitable operation so that they can use the extra money to fund their daily operations or to fund more in inventory or even expand their businesses. So next is they have a very efficient inventory management, or they don't hold the inventory too much, or they always adjust the stock based on the level of demand. Next is automation for efficiency. So it's like a very new automated warehouse that improves the stock and speed up delivery while reduces some cost. And next, Mr. DIY also have a very low reliance on borrowing because it operates mainly on internal fund, not many debt, and also it has minimal use of external financing. For the last thing, it has access to bank facilities, and Mr. DIY also maintain relationship with major banks to offer them some flexibility to some short-term needs.
There are also additional measures that Mr. DIY can incorporate in its working capital management. On the other hand, it is possible to recommend the company to introduce AI-based inventory forecasting to have more control over the stocks, particularly in the case of seasonal or fast-moving items. Second, it can take advantage of diversifying its suppliers' network and gain more lenient payment terms related to inventory movement. Third, the company may have the opportunity to develop its digital B2B sales channels with a payment credit system that will allow generating more revenue without taking on more receivable risk. Finally, putting extra cash back into more automated processes and central puts in real-time cash flow management will enhance general efficiency and enable quicker money-related decision-making. The general financial position of Mr. DIY is good and sound. The company has demonstrated the ability to manage its inventory, cash, receivable, and payable effectively. to bring about a good cash flow and a stable performance in its operations. Mr. DIY could also sustain a high dividend payout regardless of the heavy investment in automation and expansion of its stores, which implies strong internal cash generation. The company has its costs under wise management, and with its strategic investment aimed at high returns, the company ensures its sustainable growth not only in the local context but also in the Asian region in general.